My job here again is to make sure that you are welcome and you feel comfortable. I hope you are feeling comfortable and welcome after that. I think when we are faced with economic uncertainty, then people don't really want freedom. They want to find out what is that economic certainty or how can we get that economic certainty. Now, without further ado, I would like to welcome our speaker for the evening. That is the head of research at Cirrus Capital, Robert McGregor. And when he's coming, I hope you will be able to provide us with some certainty into the future. And also, obviously, with that coming economic freedom for the Namibian economy.
First of all, there's a very well-known old saying. It says that those who know do not predict, and those who predict do not know. So I think that's a very good, a very important context to start off with this evening. I think two clarifications. Firstly, I don't consider myself an expert. I don't think I'm much of an expert, but I do like to think I've got a good grasp on the Namibian economy, and hopefully I can provide some deeper insight there. And then, as mentioned, I work for Cirrus Capital, which is a research house, and then there's also a stockbroking arm, which is Cirrus Securities. So my flow for this evening will start off with just a bit of background to catch us up to speed as to where we are and how we got to where we are. From there, I'll touch on the budget, just having a look at fiscal policy. From there, leading into monetary policy, and obviously whether or not fiscal and monetary policy are working together or not. Touching a bit on some issues like investment, and then I'll close off just with sort of the general outlook from there as well. Sorry, let's see, is this good? Sorry. There we go, okay, cool, thanks. So just to start us off with the background, you can see obviously the Namibian economy has been struggling for a very long time. So it's not just since sort of the COVID pandemic that the Namibian economy has been in trouble. You can see that this is something that we've been struggling with since long before. You can see very clearly there the collapsing growth from about mid-2020 to 2020. And that obviously meant that come the COVID-19 pandemic, we were already in a very, very weak position. It left us with very little in the way of reserves to see our way through COVID, unlike many other countries. One of the important footings to bear in mind there is if you look at government's expenditure over the last couple of years, you can see there that in the early 2010s, government ramped up expenditure quite rapidly and revenue sort of kept pace for a while, but after a little bit, revenue stopped keeping pace while revenue continued to grow. And obviously that, expenditure grew. And obviously that increase in expenditure had a big impact on growth during that first half of the 2010s. Since then, government introduced fiscal consolidation, and that's the government withdrawing from the economy, which was sort of a contributor to lower growth in general. But it's not just government that found itself in trouble. Households in general in Namibia are highly indebted. So if we look at GDP from the demand side, government is around 20 to 25%, but by far the single largest part are households, which account for about 70% of GDP from that side. And Namibian households are on average incredibly highly indebted, as you can see here. So the average Namibian household having spent most of the next year's income already, and going into a weak economic growth period where we already have high levels of unemployment and those worsening, and very low levels of formal employment, leaves households with very little sort of dry powder when we start hitting difficult times, and we've seen that very clearly. Then you go into 2020, and as you can see there, obviously household indebtedness picked up. Not so much because households were just increasing their debt, actually private sector credit extension to households slowed, but what we saw was the impact on household incomes was quite dramatic. And so with lower household incomes, the household debt to disposable income levels worsened quite dramatically. And that obviously means that households are in a very vulnerable position. As 70% of GDP, they don't really have much firepower to see us kicking back into growth by spending. Then on investment, this is a very important part of GDP, so in your C plus I plus G plus net exports that you learn in Econ 101, this is sort of the part that we feel can kickstart growth, and it's something that we've spoken about for several years now. What you're looking at here is gross fixed capital investment, so investment into productive assets, land, buildings, machinery, equipment, and so on. You can see very clearly that we've had a decline since 2014 across the board. In real terms, gross fixed capital formation is back to about 2008 levels. In nominal terms, on current prices, it's back to about 2012 levels, which is incredibly worrying. You can see obviously very clear ramp up there from up into 2014, and since then a steady decline, which is understandable. In 2013, 14, 15, we had 3 major mines being built. So the Husab uranium mine, Beta Gold or Jakarta gold mine, and then Weatherly's Chile copper mine as well. Obviously, with that influx of mining investment, you'd expect sort of this big uptick in investment overall, and then once those mines are completed, you'd expect a gradual withdrawal. The concern is that we haven't seen the decline in investment stopping. That's the big danger. And obviously, this is an important leading indicator. You're not going to see improved economic growth, improved productivity, and improved employment if you don't have investment into the assets that make that possible. What you can see on the left is obviously that black part of the chart is the mining quarrying sector, and that was obviously a big contributor to that investment in the early part of the last decade. Since then, it's slowed down, but you can see towards the end it has picked up, indicating that it's really much the rest of the private sector that's been withdrawing from investment. And you can see that clearly on the right as well. What you see there is private sector versus government and SOEs, and you can see that government and SOEs have been a very small part of investment overall. The rest is private sector. And what we're seeing is that there's been a very clear withdrawal of the non-mining private sector from the Namibian economy. We put this down to various factors, including the policy environment we've created, as well as the low growth track that we're in. Obviously, the desire to invest in a low growth economy with a small population, with sort of anti-investor or anti-business policy is not ideal. And we can see the effects here very, very clearly. Lastly, if we're looking at GDP overall, you can see there that we had, no progress effectively in GDP from 2015 to 2019. The economy was effectively flat. At the same time, the population was growing over this period, meaning we had a very big decline in real GDP per capita. Then with the 8.5% contraction we had in 2020 amidst the COVID-19 pandemic and lockdowns, you can see that GDP in real terms fell back to about 2013 levels, and a lot of the growth that we're expecting in the coming years is effectively just getting back to pre-COVID levels. So touching on the budget, which was tabled last week, for those who aren't familiar with it, I've spoken quite a bit about it already. For some, sorry, my clicker isn't working very well at this stage. There we go, sorry. So in terms of revenue, first of all, you can see that revenue over the last couple of years has flatlined, which is generally quite concerning for a lot of people. Obviously, as a household, if your income isn't growing, it limits your ability to spend, especially when inflation is ticking up. So your real ability is limited there. What we can see is that over the last couple of years, because of the COVID shock, especially, government started flatlining its revenue expectations, which was understandable given the state that the economy has been in. But we can see there that in last week's budget, the revenue expectations have been lifted, not so much for the outer years, so those 2 last years in a medium-term expenditure framework, or the MTIF, but very much for this year. And the question is sort of where is that coming from? Well, it's not coming from tax revenue. And tax revenue is effectively, from the productive sides of the economy, households, so personal income taxes, company taxes, and that. Those are effectively flatlined. The expectations there are largely unchanged from what we saw last year. We think that's a sort of a good approach to take. We did see some slight down revisions in the VAT expectations, and we think that is a good change. It's more in line with what we were seeing in the trends on company and personal income taxes. What's boosting revenue, especially in this year, is non-tax revenue. These are ones-off that government is benefiting from, and the largest contributor to that in this year, or this upcoming financial year rather, are the proceeds from the MTC listing that government did last year. So the government raised about $2.5 billion from that. Initially, in last year's main budget and midterm budget, 1.5 billion of that listing was supposed to go to that year's budget deficit. That's now been scrapped. The entirety of the listing is now going to the upcoming year's budget and boosting revenue substantially. We've also seen government increasing its revenue expectations from diamond royalties as well as dividends from Namibia going forward with increased output and higher diamond prices. What's important to note is that, firstly, sample revenue has taken a hit over the last couple of years, and so it's no longer government's single largest source of revenue. Income tax on individuals is now the tax that you and I as employed persons pay. And it's interesting to note that non-tax revenue for the first time is not the smallest revenue line there either. Typically it is just below company taxes, but we see now company taxes are actually the smallest direct contributor from the major revenue lines. if we take a closer look at the tax breakdown, you can see there that tax revenue, company tax revenue rather, is a relatively small part of the economy. But obviously, without the companies, you don't see the largest contributor there, which is personal income tax. And that's where we feel, we can see sort of some low-hanging fruit for government to actually encourage growth in a positive direction in the long term. We see in South Africa, the South African government previously announced that they would cut the corporate tax rate, and last week committed to that, saying it will be effective the 1st of April 2022, and that will see their tax rate decrease by just 1 percentage point. It's not a major change, but it is a very positive signal that you send to the private sector, to aiding businesses, to marginal and struggling businesses. Government is putting a bit more money back in their hands, and obviously they can do with that what they'd like, reinvest, potentially hire more people, anything along those lines. The estimated cost for the South African fiscus is around 2.6 billion rand, so less than 0.2% of total revenue. For Namibia, we have one of the highest corporate tax rates in the region, and I'll touch on that much later. But to cut our corporate tax rate to a similar level to South Africa, it's not cut by 1 percentage point, but cut by 5 percentage points from the current 32 to 27%, would see us losing potentially around 800 million Namibia dollars. So less than 2% of total tax revenue, not total revenue overall. And we feel that that is a very small price to pay for the wider economic benefits you might see, especially with SARCA revenue that was revised upwards for this upcoming year by 1.2 billion. So that would more than have paid for a cut to the corporate tax rate. And that's a very easy change to make. It doesn't need to go through a lengthy process. It's an amendment. You change the number in the bill, it gets signed off, and it's done. In terms of SARCA revenue, this has historically been the largest line, but no longer is. What we see in terms of SARCA revenue is that government has not adjusted its forecasts for the next couple of years. They expect SARCA revenue to rebound relatively slowly to well below pre-COVID levels as well. What we did see is a slight revision upwards this year by about 1.2 billion, but it seems that government is very conservative on these forecasts, and it's probably not a terrible approach to take. What we saw in South Africa's midterm budget last year, the payments into the SARCA revenue pool upwards quite materially. But in both our midterm budget and in our budget last week, we didn't see any revisions in our expectations from the SARCA pool. So we do think that in the outer years, so not in 2022, 2023, but the 2 years thereafter, we think that there should be some revisions, upward revisions coming in there, and that will also improve overall revenue. But I think the important thing to bear in mind is that overall revenue as a percent of GDP is remaining around close to 30%, meaning we're still one of the most well-resourced countries on a relative scale across the globe. And so it's really not a revenue problem that we're sitting with. We sit more with an expenditure problem for government and sort of maintaining that expenditure. And what you can see there is that, especially from the early 2010s up until about 2015-16, government went on a very large increase in expenditure, and obviously that did fuel growth to a large extent. Government then went into fiscal consolidation, and you can see that pullback in spending obviously also impacted growth overall. And since then, government is expected to flatline its expenditure, which is that idea of fiscal consolidation, keeping expenditure relatively flat while revenue grows up to reduce the deficit. What was interesting to see is that government is no longer as committed to fiscal consolidation. They're talking about a balanced approach to fiscal consolidation. And that you can see in that pink line there, the expenditure ceiling for the next couple of years, including this year, has been revised upwards slightly. So we're not seeing smaller deficits with these high revenue forecasts. We're still seeing quite large deficits running forward. This is positive for growth over the longer term because we are now not seeing government act as a drag on growth in real terms anymore. But the question really comes down to the quality of that expenditure, and that is a real big concern. You can see there that by far the single largest part of government's expenditure is current expenditure, and by that the largest part is obviously the civil service wage bill, which has been spoken about many times. Another large line within government's expenditure is obviously the interest payments, the cost of the debt that we've been issuing over the last 11, 12 years, which has helped fund a lot of that expenditure. By far the smallest line is what we spend on the development budget. That's sort of the low-hanging fruit where we could see material improvements. You can see there that for the next couple of years, government is actually expecting to reduce its development expenditure, not just as a percentage, but in overall terms as well. And that's very concerning because that's where we can see wider, longer-term economic benefits. That's spending that has greater economic returns and can also improve government's revenue in terms of the ability to conduct business in this economy. And so we're really not spending money on the right places. What's also interesting to note is that while government has raised its expenditure ceiling for the next couple of years, so in 2023, 2024, and then again in 2024-25, government hasn't allocated that money to any particular line yet, and that leaves a big question. Does this provide room for maybe reducing expenditure because it has not been allocated, or is that allocation going to somewhere that it doesn't need to? And so this is something that we hope to see some answers for in the coming midterm budget, because there are large amounts allocated to the Ministry of Finance in those years, which obviously won't be spent by the Ministry of Finance, but allocated to other lines across the budget as yet to be determined. In terms of debt and the deficit, you can see there that the budget balance, so the deficit is expected to remain quite large. You can see that in the last decade, so in the 2010s, we had a sort of a structural deficit of about $8.5 billion Namibian dollars a year. So the government was spending $8 to $8.5 billion more than it was receiving in revenue each year. Then obviously during the COVID pandemic, that increased where revenue collapsed and there was need to increase expenditure, and we saw structural deficits of around 16, 17 billion. And now for the next couple of years, we're still seeing very large structural deficits, because even though the revenue outlook has improved somewhat, the expenditure ceiling has been lifted as well. So we're looking at average deficits of around 11.4 billion Namibian dollars over the next 3 years, which is quite substantial. And this obviously means that we're going to be seeing a large increase in debt. So when you've got more expenditure than revenue, you need to borrow money to make up for that. And that's obviously going to see public debt increase quite rapidly as well going forward. So you can see the massive jump in public debt levels in 2011 and again in 2015 with the issuance of the 2 Euro bonds. But the pace of debt accumulation has still been very high because of these large deficits we continue to run. So we're seeing debt to GDP expectations of around 71% by the end of the 2022-2023 financial year. So total debt levels of around 140 odd billion dollars, and then increasing to about 75% of GDP overall in the out year of the MTEP. And so many people will say, yes, but there are other countries with much higher debt to GDP levels, and that might be true, but we're spending 15 to 16% of our revenue just on servicing the debt that we are issuing. The threshold for reference set by government is 10%, and so that's a very unsustainable position. In other considerations as well, other economies that are issuing a lot of debt are seeing much stronger growth over a much longer term, and their ability to repay that debt is also far more confident than what we can see here. In terms of the deficit overall, you can see that the deficit is expected to remain quite large at around 5.5% of GDP going forward. So that's even with nominal GDP growth of around 5.5% that government is forecasting for this period. What's positive to see is that government is expecting a primary deficit. So that's revenue and expenditure less the interest payments. So interest payments aren't considered in the primary deficit, and that's expected to start narrowing as well. We saw in the midterm budget government was planning to run a primary surplus within the MTIP, which we thought was very optimistic. That's now been changed. They do still expect primary deficits, and we think that's a very realistic and positive adjustment to see in this budget. But we are still seeing large deficits, and the deficits over the medium term have been increased compared to what we had in the midterm budget, which is not a very encouraging sign. In addition to the borrowing that government needs to undertake to fund the deficits, government also has to issue debt, and that's what happened in the early part of the last decade. We went on a large ramp up in debt issuance, and that debt is starting to fall due, which means that over the next couple of years, not only does government have to borrow money for the deficit, they now either have to issue more debt so where this debt that's now coming due, they either have to repay it, and they need cash for that, which increases the borrowing requirement, or they need to roll that debt, so reissue it, in what is now becoming a high interest rate environment, meaning it's becoming more expensive, and obviously that's negative for the cost of funding. That sees the rising cost of funding, and that also, we're already spending 15-16% of revenue on the cost of funding, raises a major concern. So government is really needing to borrow a lot of money, not just for its deficits, but also for the prior spending we had in the last decade. And that leaves us with other concerns as well, where government has a material domestic borrowing requirement. So government is looking to raise most of this money from the domestic market. They generally have an 80-20 split, so try and raise 80% in the domestic market and 20% internationally. And this is done under the guise, I think, in the fiscal strategy by government. They say this is to strengthen or improve or deepen financial markets or capital markets in Namibia. That may be so, but there's only so much money available in Namibia to do that. And largely the pension funds are the holders of that debt. So we can see that last year government needed about 19.5 billion in the domestic borrowing requirement. In last week's budget, somehow the 2021-2022 number was revised down to 17.7 billion. We've recreated the tables and we can't seem to see where that 1.8 billion reduction comes from. It's not in that table. And so there might be an underestimation there, which is something important to bear in mind. But you can see that we're still looking to raise upwards of 12 billion from the domestic market over the next couple of years. And that's also contingent on more AFDB funding down the road. In the budget documents, this is stated in 2024-2025 as a COVID relief financing, which seems a bit odd given how far down the road it is. But there is a very large reliance on the domestic market, and it's somewhat understandable because obviously there are risks with hard currency debt, the currency moving against you and making it more expensive. But at the same time, it's very difficult to keep borrowing from the same market where there's a limited pool of funding, which is subject to regulatory requirements. And so what we're seeing is that government is needing to issue a lot more debt for its deficits and for its maturity profile, so of the debt that's coming due. But oddly enough, they're expecting the interest payment growth to start slowing down over the next couple of years. And that seems questionable given the fact that they need to issue a lot more still. The local market seems to be completely satisfied with what they've already been issued, and I'll touch on it just now. And we're moving into a high interest rate environment. So the marginal cost of funding should likely continue increasing, not slow down. And we've seen that. That's the chart on your right. That's effectively how much more percent government pays than the benchmark South African government bond. And you can see that those spread movements mean that it's become more and more expensive for us to issue debt locally in local terms, or for government rather. And then so that's really a concern in terms of the sustainability of its funding. Why I started with that is because this fiscal policy has a big impact on monetary policy. Monetary policy is effectively a fancy term for the repo rate and the impact that that has, which the Bank of Namibia announced the increase of last week. And so if we look historically, sorry, my slides are jumping. You can see there that we had rather low interest rates during a very long sustained period of economic growth in Namibia. And generally you'd think that, when there's strong economic growth, we'd start seeing interest rates rising to counter that. Because you then have the scope to do that and you don't want the economy to overheat. But rather we had for a long time continued low interest rates, and that was because South Africa was struggling in terms of growth and had been cutting the repo rate there, and we decided to follow suit. And that also obviously helped boost and sustain a lot of the growth we had during that period. Then obviously with the COVID-19 pandemic, we saw those large cuts to the repo rate in 2020. And your economic 101 theory would tell you that when you cut interest rates, you'd expect lending to increase, but that is not what we saw. You can see there very clearly that from around 2015-16, credit extension to households, to individuals, so debt taken up by individuals or households started slowing down quite dramatically. And even with these big interest rate cuts that we saw in 2020, it has still remained incredibly low. In fact, if you adjust it for inflation, it's been negative. And that's counter to what your economic theory would tell you. And while that might be the case, we think that there's a very clear reason for that. And that's effectively because of government needing to issue so much debt in the domestic market, it's done what we call crowding out. Because obviously there's a limited pool of funding available within the economy if you're not bringing in foreign money. And what happens there is government funding obviously, or government funding requirement starts to compete with the funding requirement from the private sector. So what this chart shows you is that it's effectively the prime rate, so the prime lending rate that most people here will be familiar with, less the yield you get or the interest you get, the rate you get on a 10-year government bond yield. And obviously, the lower this is, the more attractive it is to governments. And so what we've seen is that government needing to issue a lot of money in the domestic market has led to a very clear case of crowding out. But it's not surprising given the size of government's issuances, also the macroeconomic risks we face. So what's happened with these administered interest rates, like the repo and prime rate, is that through lenders have been told, well, you need to lend more. We've brought down the cost for people to borrow money, but credit risk remains incredibly high. And so, for instance, if you are someone who lends out money, you're sitting in a position where you're told, well, the rate at which you can lend out has come down quite a lot, but credit risk remains very high. Unemployment is high and increasing. Household incomes are low, and worsening. A lot of the debt that is issued is for mortgage loans, for instance, and there's been deflation in the housing market, meaning that the asset which you use to secure that loan is losing value as well. Whereas on the other side, you could lend to government, which is desperate for funding. It's offering you much higher rates, and it is effectively the risk-free lender on a much shorter time span as well. And so that's led to this very clear case of crowding out. So fiscal policy has effectively very much weakened the monetary policy we have. Not that monetary policy is the way to get us out of the hole that we're in. In addition to that, the concern is that the pension funds, as of last year, were well above the domestic asset requirement. So pension funds have been a large buyer of government debt for a long time, and they're subject to the domestic asset requirement, meaning that 45% of pension fund assets must be invested in Namibia. What we saw in the second and third quarters of last year is that the pension funds were well over 45% allocated to Namibia, and that means that the new demand for government debt has started slowing down as well. Thank you very much. And so this means that going forward, the scope of demand for government debt is likely to start slowing down as well, and that means that government will either have to reduce its reliance on the domestic market, or it will have to start paying up more and more for debt as well, and that's obviously not conducive to lending to the private sector. Bearing in mind that when we spoke earlier about government expenditure, not all of government's expenditure is productive, and so where they borrow money, that isn't necessarily all going towards productive expenditure. Whereas, when we tend to see a lot of private sector borrowing for households, it's not always productive as well, on your credit card, on your overdrafts and similar. But what we do see, especially for businesses, that tends to be more productive borrowing, and that obviously has longer term economic benefits. And so the crowding out has really had negative consequences for Namibia's economic growth trajectory. So where is the growth rebound coming from? A large part of it is reliant on the mining sector. So diamonds, we believe, will be the key driver of growth over the short term, this year, next year. One of the main reasons for that is Namib's new mining vessel, the AMD3, coming online later this year. That vessel can add about 500,000 carats to production, and in a very good production. And in terms of real GDP, that's going to be a big contributor going forward. The onshore mines at Namibia have also received a royalty holiday, which will allow them to extend their life of mine and continue producing. And also, obviously, Spaghetti mining has taken over the Elizabeth Bay mine, and that will be continuing to produce carats as well. In terms of other sides of mining, we see Roshpina going ahead with its expansion, and that will see more zinc output as well, so that will increase output dramatically over the next couple of years. We're seeing expectations for higher gold production as well, with Peter Gold moving underground. There's an exciting development with potentially new gold mines, including the Isina Gold Resource Project, and that is the Isina Resources 20 Hills Gold Project, although that at best still a few years down the line. But there are positive mining developments, and we're seeing renewed interest in mining in Namibia, and that is positive, but it does mean that we still have this very large reliance on the mining sector to carry us through in terms of growth. As mentioned earlier, obviously we've had much better rains, and you can see here that the dam recharge over the last couple of years has been much improved compared to what we've seen over the previous years. And so what this means is that going forward, we expect to see a large improvement in agricultural productivity. For crop farming, it's a lot more instant, right? You've got good rains this year. If you plant it, you reap the benefits within the same year. But for livestock, which is generally a larger part of the agricultural GDP, it's a much longer lead time. Obviously, herds were reduced during the drought years. Now you need to rebuild those herds. And obviously, you need to have new cattle born. Those take a while to mature. So the growth stemming from that will take many years to come back. And so we expect from the livestock side, especially the larger livestock, which has a longer lead time, we expect to see that growth starting to pick up more from sort of 2023, 2024, as opposed to now in the short term. And we see that very much in the cattle livestock marketing numbers as well. In terms of tourism, and this is a sector that has obviously and rightfully attracted a lot of interest over the last few years, and you can see there how clearly it was hit by the COVID-19 pandemic, with occupancy rates dropping dramatically, with international travel bans, our borders being shut as well. You can see it started picking up. We had the Delta wave, which obviously worsened things, Namibia being red listed, and then again with the Omicron wave as well. And so that's obviously had a big impact there. The occupancy rates do look better, but they do belie a lot of the facts behind the data. And one of the main ones is the quality of that occupancy. And there has been a big drive for local tourism, and that is positive. But the fact remains that local tourists don't have the spend available that international tourists do. And there's nothing wrong with tourism catering for international tourists. Obviously, there's good money to be made. There's an important export industry that brings in hard currency reserves. And tourism is a very big, important employer in a lot of rural areas where there are no other jobs available. And as far as labor is concerned in Namibia, it's not necessarily very highly skilled labor that is required, and it's also not backbreaking work like agriculture or construction may be. But the danger is that the occupancy has changed dramatically over the last years. Prior to COVID, it was over 50% foreign occupancy. Over the last couple of years, we've seen that shift to 50% or more Namibian occupancy. Obviously, Namibian occupancy attracts a much lower spend. We believe around a third to a half of what your foreign tourists spend. And that obviously means that the tourism industry is far less profitable. In addition to that, we've seen a lot of the tourism spend change. So we haven't seen investment or rather sustained capital spend. So in fact, we haven't seen companies or the tourism industry doing much maintenance to reduce their costs. That obviously has longer term consequences as well for the ability running forward, and so they've reduced their costs artificially to a large extent to remain afloat. But we do think that over the longer term we will start seeing that rebound. I think what's very positive to see is firstly government's response towards the tourism industry throughout COVID has been quite positive. For instance, the 7-day allowance for PCR tests as opposed to just 72 hours, as well as globally we're seeing more of this move by governments to live with COVID as opposed to reintroducing lockdowns all the time. So we do think that over the next couple of years, we will start seeing an improvement, a gradual improvement there. So we can see that in terms of international arrivals, they did start improving last year, but they are still well below pre-COVID levels. These are also obviously limited by far less flights available to Namibia, especially with some of the major international airlines not flying directly to Namibia anymore. In terms of investment, and this is something that we've stressed a lot in the past, Namibia's overall investment as a percent of GDP has been in decline for many years, as spoken about earlier. And often we hear it attributed to external factors, but this shows you very clearly that this is a domestic trend, not an international trend. And so we feel that it's very much down to the policy environment we've created for ourselves as well. And that's the big concern for us. This is something that we can fix to change things around. It's not something we need to wait for someone else to fix for us. You can see that for a long time we've been reliant on foreign direct investment. So anything below zero here is foreign direct investment into Namibia. Anything above zero is net direct investment out. And you can see that from about mid-2018 we started seeing net foreign direct investment outflows. What's positive to see is that in the first and third quarters of 2021 we had net inflows again, but again those are largely mining related. So it's really much the mining sector that's coming to the party and saving us on that front again. And if we think about Namibia as an investment jurisdiction, yes, we do have a lot of good positives that we can speak about. A lot of the basics, good, good, well-developed financial system, good basic infrastructure. But when we compete on the region, we don't compete on tax. While the 10% dividend withholding tax, has been delayed, so we hope that it's not going to be introduced at least, with this high corporate tax rate. But that is a big concern. We have the highest, or amongst the highest, electricity tariffs in the region, amongst the smallest population, and so therefore smallest market sizes. And as far as starting a business is concerned, we rank very, very poorly amongst the region as well, which is a very major concern. These are small things that we can change very easily, even though we've been speaking about them for more than 10 years now. And so to start bringing things to an end, on the fiscal front, we are seeing this balanced approach to fiscal consolidation, which is sort of positive for growth over the next couple of years, although the sustainability of that is another question, as well as the efficiency and allocation of its spending, which remains a challenge. In terms of monetary policy, we are seeing continued pressure to hike interest rates. We believe the Bank of Namibia won't really move ahead of the South African Reserve Bank. We think we will follow suit when they do hike. But we aren't as hawkish as a lot of others. We don't think these estimations of sort of 7 or 8 or 9 rate hikes over the next sort of year or so are accurate. We think it will be a lot slower. These things often do take a lot longer and a lot slower to play out than what many people expect. But the big issue here is that fiscal policy is impacting monetary policy. And that's something that needs to be addressed as well. In terms of reforms that we've seen, again, in last week's budget speech, we didn't see anything major there. It's many of the same reforms we've heard for many years. We haven't seen anything new or concrete there, and that remains a concern. You know, we've been speaking about the same things for many years, and that shows us that there's a clear lack of implementation as well, and that remains a big hindrance for us. And in terms of tax, well, the big concern there is that we seem to be focusing on taxing the same base as opposed to growing the tax base. And that's through seeing growth, through seeing investment, having more companies in Namibia, more companies that are profitable, more people employed, and more people paying personal income tax, as opposed to efforts to tax the same base over the same time. And where we have seen positive tax reforms, as small as they may be, for instance, the pension fund deductibility, we've been hearing those for many years, and again, we haven't seen any implementation coming through. So what do we reckon for growth? Well, we think growth of around 3% for 2022, which is a big change from what we've seen for the last 5 or 6 years. It's important to bear in mind that while this growth number does look good, and we expect growth to hover around the 3% mark over the next couple of years, we're taking a long time to get back to pre-pandemic levels, so back to pre-COVID levels, and then from there start growing, which means effectively we've lost out on about 8 or 9 years of growth, and that's something very important to bear in mind. A lot of the growth as well is base effect growth, so slowly returning to pre-pandemic levels of operations for businesses, especially in the manufacturing sector, and then also a lot of it is mining sector led, especially over the next 2 years. In terms of inflation, and this is what a lot of people want to hear and want to know, well, yes, inflation is high globally, but in Namibia, inflation is actually quite low at this stage. So you can see there that we're forecasting growth of around inflation of around 4.8% for the year ahead, and we do expect it to start slowing down, decreasing next year because of a bit of a base effect. And a large reason for this is because rent inflation in the country has been flat for the last couple of years, as the statistics agency has reported it. I'm sure for many of those, especially in the middle to upper income side of things, we'll see that rent actually hasn't been flat. Rent has been decreasing for a lot of people. And so where we do have inflation, it's not in the largest part of the inflation basket, although the inflation basket is very outdated. It's from 2009. And it needs to be updated now with the delay in the census. That would take much longer to achieve. But where we are seeing inflation is where it's going to bite. It's in food prices and it's in fuel, as we've noticed and are continuing to notice. For low-income households, that obviously this affects disproportionately. For those who have to spend a lot of money on public transport and similar, that's where we're going to see inflation bite, and obviously that's going to lead to a lot more social issues and a lot more social pressure as well. And that should bring my presentation to an end. I know I've taken a lot of your time, but thanks for listening.